Imagine you walk into a bank tomorrow and deposit $10,000. You probably think your money is now sitting in a vault somewhere with your name on it. It isn't. In fact, by the time you leave the building, most of that money could already be on its way to someone you've never met. Maybe it's helping to family buy a house. Maybe it's funding a new restaurant. Your bank didn't just store your money, it put your money to work. And that's where one of the biggest misconceptions about banks begin. Most people think banks sell money. They don't. What banks really sell is time. Here's what I mean. Sarah has $20,000 that she won't need for the next 5 years. Michael wants to buy a car today, but won't earn enough money to pay for it until the next 5 years. Sarah has excess money, Michael has an immediate need. The bank sits in the middle and connects those two people. It borrows from Sarah, it lends to Michael. That's the entire banking business in one sentence. If Sarah could simply keep her money under her mattress, why will she ever give it to a bank? Because the bank pays for interest. Interest is essentially the price of using someone else's money. Think about renting an apartment. You don't own it, you pay rent to use it. Money works the same way. When you borrow someone else's money, you pay rent. That rent is called interest. Here's where banks make money. Imagine the bank pays Sarah 2% every year. Then it lends that same money to Michael at 6%. The bank isn't creating profit out of thin air. It's earning the difference. That difference is called the interest spread. Here's something that surprises almost everyone. Banks don't keep every dollar that customers deposit sitting in cash. If they did, they couldn't make loans. And if they couldn't make loans, they wouldn't be really banks. Modern banks keep enough highly liquid assets to meet expected withdrawals while investing or lending much of the rest. They are also subject to capital, liquidity, and other regulatory requirements designed to reduce the risk of failure. Imagine you invest $1,000. After 1 year, it grows to $1,100. Next year, you don't earn interest only on the original $1,000. You also earn interest on the first year's interest. Your money begins making money, and that money starts making money. That's why compound interest is often described as interest on interest. The longer the money stays invested at a positive return, the larger the effect becomes. Banks aren't magical money printing machines. They are financial intermediaries. They connect people who have money today with people who need money today and expect to repay over time. The entire global economy depends on that simple exchange. Every business loan, every credit card, every startup, every shopping mall. Somewhere in the background, there was probably a bank connecting someone's savings to someone else's opportunity. Follow and learn finance simplified.